Okay, so in chapter one, we introduced accounting as a whole and what the purpose of accounting is. We looked at some transaction analysis and went through several examples of how to apply those using the accounting equation. In chapter two, we're going to get into uh, the nuts and bolts of what we call double entry accounting. So our learning objectives for chapter two will take us all the way from source documents, which is where we obtain the information that then we analyze and record, and then ultimately we post, we create a trial balance, and then we prepare financial statements. So this chapter is going to go through kind of start to finish all of the nuts and bolts of double entry accounting. So let's look at the steps in processing transactions and the role of source documents first. So we said in chapter one that accounting is basically the process of identifying, recording, and reporting a business's activities. And the way that we do that is summarized here super high level. So first, we identify the transactions and the events. We analyze them using the accounting equation, which is what we did in chapter one. The steps that we're adding on here in chapter two, we record the transactions and events in what we call a journal. Then we post the journal to the ledger accounts, and then we prepare and analyze the trial balance and the financial statements. And I recognize a lot of those words are foreign, but as we proceed through this PowerPoint, you'll get a better understanding of what those are. So we said that accounting is the process of analyzing, recording, and reporting on the activities of a business. And the way that we do that is through source documents. So what source documents tell us as accountants, they'll give us information about the transactions and the events that are happening, and then we use that information to record the activity in the accounting records. So examples of source documents include things like employee earning records, checks that maybe you've written to pay your suppliers or pay your employees even, bills that you receive from suppliers, any purchase orders, bank statements, sales tickets. They're those types of documents where we obtain the information that we need to then record the activity in the accounting records. So let's talk about what an account is and how we use it to record transactions. Okay, so real quickly, just a couple definitions before we get into the meat of our discussion here. But an account is the record of the increases and decreases in a specific asset, liability, equity, revenue, or expense item. And then the general ledger is the record that contains all of the accounts that are used by a company. So if you remember in chapter one, we talked about the accounting equation, assets equal liabilities plus equity. And I said you should memorize that. Well, here it is again. So in this case, all they're trying to illustrate, I think, is that if you picture the components of your accounting equation as file folder drawers, and then your accounts as the folders within the drawers, that's kind of how that's the relationship between the accounting equation, I guess, and the accounts, if that makes sense. So we talked in chapter one about assets being resources a company has that are expected to provide future benefit. So here's a slide with some examples of various types of asset accounts. And so you have cash, land, buildings, equipment, supplies, all of that stuff is pretty common. In fact, everything on the slide is pretty common to most businesses. A couple things here that are not quite as straightforward would be your accounts receivable, notes receivable, and prepaid accounts. So when you have a receivable of any kind, it's money that's due to you as the business, but you haven't yet received in cash. So if I make a sale on account to ABC customer or Joe Schmo, we like Joe Schmo. Let's say I sell him 2,000 widgets for $2,000. And Joe Schmo says, hey, I'm going to pay you in 30 days, bill me. We're going to record the revenue. And rather than recording cash, because he hasn't yet paid us, we're going to record an account receivable. And then when he pays us, the account receivable goes away and then we get cash. So we'll get into more of how that works, but that's generally how receivable accounts work. And then prepaid accounts, so if you think about your auto insurance, maybe you pay that in advance, 6 months at a time or maybe 12 months at a time. When you make payments in advance, they're referred to as prepaid amounts. And then ultimately what happens is that prepaid will become expense as the policy period expires, basically. And we'll get into detail about how that happens as well. Okay? Okay, so here's a listing of common liability accounts that we're likely to see in the general ledger of just about every business. The one that's probably a little bit uncommon here, or the one that I at least want to address or mention, is this idea of unearned revenue. So unearned revenue is a liability where we've received the cash, but we haven't yet provided the service or the product that the customer gave us that cash for. So for instance, if you subscribe to like a magazine, generally you pay for that subscription 1 year in advance. And so when the publishing company is recording that, they're going to record cash, but they can't yet record the revenue because they haven't done anything to earn it yet. So as the magazine is delivered to you, they'll recognize a portion of that unearned revenue as revenue, and then they'll reduce the liability. And again, this is super summary, just kind of introducing some ideas. We're going to get into plenty of examples of all of this as this particular chapter goes on, and then also in the coming chapters. Okay. Okay, and so then the last piece of our accounting equation are the equity accounts. So we defined last week that equity is basically what's left over, um, or the owner's residual interest in the assets after deducting liabilities. It's also referred to as the owner's claims on a company's assets, which is why it's typically referred to as shareholders or stockholders' equity. And so equity is impacted by four types of accounts. And so if you remember from last week when we talked about the expanded accounting equation, not only did we say that assets were equal to liabilities plus equity, but then we said it could also be said that assets are equal to liabilities plus common stock less dividends plus revenue less expenses, because those are the four types of accounts that impact our equity. Okay. So this slide's pretty similar to the one just a couple slides ago, whereas if you think of your accounting equation as the file drawers and you think of your accounts as the folders within those file drawers, the same idea can be applied to the components of the equity file folders. So it's almost like you have subfolders. Um, so that's where they have the little file drawers on the bottom there, common stock, dividends, revenues, and expenses. Common stock, really, you can only have a couple folders within that file drawer, so to speak. You'll have usually common stock, preferred stock, and maybe treasury stock, but there's not as many types of common stock accounts. And then your dividend file drawer, really, dividends is just dividends. So you don't tend to have multiple types of folders within your dividend account category. Dividends just are what they are. And then revenues, you may have a few file folders in that drawer. You could have subscription revenue, maybe you could have fee revenue, you could have rental revenue, maybe, but not too many different types of revenue. Revenue is usually just revenue. So, some companies will break it down in a little bit more detail than just general revenue, but it's not going to be broken down like you'll see like in the expense file drawer. You'll have a bunch of different folders there because you'll have salary expense, electric expense, gas expense, water expense, and so on. Okay? All right, so let's see if we can classify each one of these accounts in the right bucket. Are they an asset account, liability account, or equity account? So if you remember, assets are things of value that are owned by the company, liabilities are owed to creditors, and then equity is the residual interest. So the first one's prepaid rent. So the thing to know about this is that anytime you have prepaid in the account name, it's always an asset. So is prepaid rent an asset, liability, or equity? It's an asset account, right? And what about common stock? It's an equity account, right? Our expanded accounting equation, equity can be expanded to be plus common stock, less dividends, plus revenue, less expenses, right? All right, and then number 3, note receivable. So another thing to know is that anything that has receivable in the title is also always an asset. So note receivable would be an asset. What about number 4, accounts payable? Another keyword, payable. Anytime you see payable, always a liability. So number 4 is a liability. What about number 5, accounts receivable? So it has one of those key words, right? So it's an asset. And then what about equipment? Things of value owned by the company? Sounds like an asset to me, right? Right? Interest payable has one of those key words. It's a liability. All right, and then number 8, unearned revenue. That's a tricky one. Anytime you have anything with unearned, it's always going to be a liability. So that one's a liability. And then what about land? Things of value? I'd say so. So that's an asset. What about prepaid insurance? So it has that keyword prepaid. Always an asset. That's right. And then wages payable and taxes payable. So those also have the keyword payable in them. So they're both liabilities. Okay. All right, so I hope you did well on that. Let's move on to the next section. Okay, so let's talk about a ledger and chart of accounts. Okay, so we said just a few slides ago that the general ledger is the collection of all accounts for a company. And then all that we're elaborating on here is just mentioning that the company size and the diversity of their operations affects the number of accounts that are needed. And that the chart of accounts is just the list of all the accounts, and it includes an identifying number for each account. So typically the way that this works is most businesses, the chart of accounts can be anywhere from 10 accounts to, tens of thousands of accounts depending upon how large the organization is. But the one thing that tends to be pretty consistent among all of them is that your cash accounts always usually start with a 1. I'm sorry, your asset accounts always usually start with a 1, liabilities 2, equity 3, revenue 4, and then from there it varies, but a lot of times you'll see if it's an inventory type company, they have cost of goods sold expense accounts. Those will typically be 5s, and then maybe your 6s, your accounts that start with 6 will be your general and administrative expenses, so rent expense, insurance expense, supplies expense, utilities, those kinds of things. Okay. All right, now here is where the nuts and bolts of accounting really starts. So now after I teach you this, I'll be able to start cracking some of my jokes and you'll understand what they mean. So get excited. Here we go. Debits and credits, double entry accounting. All right, so accountants use what we call a T account oftentimes to analyze transactions before the information is actually entered into the journal. So the T account is really just supposed to represent the general ledger account, and it's really just an analysis tool, so to speak. And so the way that the T account's used is that if you're wondering where it gets its name, T looks like a T, right? So your account title would go at the top, and then debits always belong on the left side, and credits always belong on the right side. And so the significance really behind the terminology debits and credits comes from like way back when the first double entry accounting system was developed. So we still use those terms today, but they really don't have any significant meaning other than they stand for the left side and the right side of the ledger. So when the sum of the T account debits exceed the sum of the credits in a particular account, the account is said to have a debit balance, and then vice versa. When the sum of the credits exceeds the sum of the debits, the account is said to have a credit balance. Okay? All right, so double entry accounting requires that each transaction have at least two accounts that are involved, and you have to have at least one debit and at least one credit. And the total amount of your debits must equal the total amount of your credits, and you can't violate your accounting equation. So we talked last week about how assets equals liabilities plus equity, and we said that this side must equal this side, or we got a problem. Well, the same thing would be true if your debits don't equal your credits. We also have a problem. Okay? So, like we had said just a minute ago, the words or the terms debits and credits don't really mean much of anything other than debit is the term used to refer to the left side of the T account or the left side of the general ledger, and credit is the term that's used to identify the right side of the ledger or the right side of the T account. And so now we have to say, well, what does debit and credit mean? Does that mean increase? Does it mean decrease? And does that change depending upon the type of account we're talking about? And the answer to that is yes. So assets, in order to increase asset accounts, we're going to debit. And in order to decrease asset accounts, we're going to credit. And then if you flip to the other side of the accounting equation, the opposite would be true. So to increase liabilities or to increase equity, we're going to credit, and we'll debit to decrease those. Okay, so this isn't, this is probably one of those things that you're just going to want to memorize. I don't know that there's a whole lot of common sense behind it, other than I guess you could say because assets are on the left side of the accounting equation, you debit to increase them, or you use the left side of the T account to increase. And then because your liabilities and your equity are on the right side of the accounting equation, you could say you use the right side of your T account or the credit side to increase. But I don't even know, there's not really a good rhyme or reason to help this click, I don't think. It's really just going to be a matter of practice and memorization. Okay, so here, if we take a look at the expanded accounting equation, so same thing is true. Your assets, debit to increase, credit to decrease, liabilities, credit to increase, debit to decrease. But then when you look at the equity part of your accounting equation in the expanded format, it's a little bit of a trick to it. So the thing that I want to point out here, let me find my pen. So if the plus sign is in front of the account, it works the same way as equity or the same way as liability. So because you have a plus sign here in front of common stock, credit's going to increase it, debit's going to decrease that balance. But because you have a minus sign here in front of dividends, debit is going to increase instead, and a credit is going to decrease. Your revenues, there's a plus sign in front of revenues, so it's going to work the same way as common stock and the same way as liabilities. But because you have a minus sign here in front of expenses, you're going to do the opposite. You're going to debit to increase expenses, and you're going to credit to decrease them. So again, this is another one of those where you're going to want to just probably memorize it, because I don't know that there's a whole lot of logic behind it, really, at all. So I would bookmark both the previous slide and this slide, and just kind of review these, and then as we apply examples to them, hopefully it'll start to make some sense to you. Okay? All right, so all they're trying to show us here is how to compute the balance in a T account. So the account balance is really just the difference between the increases and the decreases in the account. And so in this case, we're talking about the asset account cash. And so when you're talking about an asset account, the left side of the T account debits less the right side of the T account credits gives us an ending balance or a normal balance of a debit in our asset account cash of $4,800. Okay. All right, so they're asking us to identify whether the normal balance is a debit or credit for each of the following accounts. And so whatever it is, debit or credit, that increases the account, that is also the normal balance. So if it's a debit to increase the account has a normal balance of a debit. On the flip side, if it's a credit that increases the account has a normal balance of a credit. Okay, so we can put some clues up here on the slide. So in order to increase assets, we have to put a debit on the left side of our T account. But the contrary is true for liabilities and equity. Okay. So if it takes a debit to increase the asset accounts also have a normal balance of a debit. And then if it takes a credit to increase the liability accounts, liabilities also have a normal balance of a credit. And when it gets to equity, it gets a little bit tricky because not all equity accounts or not all pieces of the expanded accounting equation work the same way. So your common stock and your revenues increase equity and they have a normal balance of a credit, but your dividends and your expenses work the opposite way. They have an inverse relationship with equity. And so in order to increase your dividend account and increase your expense account, you need to debit. So therefore the normal balance is a debit as well. Okay. So let's go through number one. So number one, first of all, we should identify what type of account is it. Is it an asset, a liability, or an equity account? It has one of those key words in it, right? Prepaid. We said whenever we saw the word prepaid, what type of account is that? It's an asset, right? And so in order to increase an asset, what do? We debit, which also means that an asset has a normal balance of a debit. What about common stock? What type of account is that? It's an equity account, right? And so to increase equity accounts, what do? We credit. And so whatever it takes to increase the account, we say that's also the normal balance, right? So it's a credit. Note receivable. It has one of those key words in it, receivable. Anytime you see receivable, you know that's a asset account, right? And so asset accounts have a normal balance of a debit. Accounts payable. That also has a key word, payable. Anytime we see the word payable, what type of an account is that? Liability, right? And liabilities require credits to increase them. And whatever it requires, credit or debit, that increases the account, that can also be said to be the normal balance, right? So credit is the normal balance of an account payable. What about an account receivable? Again, receivable in the name. So that's an asset account, and asset accounts have a normal balance of a debit. Equipment. Equipment is also an asset account. Asset accounts have normal balances of debits. Interest payable, it has one of those key words, payable. So it's a liability account, right? And liability accounts have a normal balance of credit. Unearned revenue, that's another one that had a key word. Anytime you see the word unearned, you should think liability, right? And liabilities have a normal balance of credit. Land is an asset account. Assets have a normal balance of debit. Prepaid insurance, that's another one that has a key word, prepaid, right? Anytime you see the word prepaid, think asset, and assets have a normal balance of a debit. And then dividends. So dividends are part of your expanded accounting equation, but they work the opposite of equity, right? So there's an inverse relationship between dividends and equity. The higher your dividends, the lower your equity. So it works the opposite way that common stock and revenue work. So dividends, in order to increase dividends, we debit. So therefore, it's said to have a normal balance of a debit, right? All right, I hope you did well on that. Let's move on to the next section. All right, so now we're going to record transactions in the journal and post the entries to a ledger. All right, so there's 4 steps. Step 1, identify the transaction. Step 2, analyze it using the accounting equation. So that's what we did in chapter 1, where we said, okay, what 2 accounts are affected and are they increasing or are they decreasing? Then we're going to record the journal entry, and then we're going to post the entry to the ledger. All right, so when you journalize transactions, there's a couple key things that you want to kind of keep in mind. So the first column of your ledger is usually the date column. So that's the transaction date. Then the next section is your account titles and explanations. Then the third and fourth columns are your debit and your credit, or this is the left side, right? This is the left side of your T account or the left side of your ledger. And then the credit side is the right side of your T account or the right side of your ledger. Okay, and then there's usually some kind of transaction explanation of some sort. Okay. All right. So T accounts are really useful illustrations, and believe it or not, they're actually quite useful. I use them even in real practice, like used them last week to try to figure out some different transactions. So it is actually a tool that's something that you learn in school and is actually applicable to the real world. But never mind, I digress. So they're useful as illustrations, but the balance column and the ledger accounts are used in practice. So the T account gives you both sides of the transaction, but when you're actually looking at a general ledger, you can't get things in T account form. What you end up doing is you pull the ledger for the account cash, or you pull the ledger for the accounts receivable, or you pull the ledger for the account land. And when you do that, what you're going to get is just all of the transactions that hit that account. So like for instance, this first line item here where it says the first transaction was a debit of $30,000. The reason why you're not seeing your debits and credits equal here is because you're only seeing the cash side of those transactions. So the other side, our credit side of our $30,000 is in some other general ledger account, and here they're just showing us the general ledger cash. Okay. All right, so the thing about posting journal entries, so the idea behind posting is really just the process of transferring the information from the general journal to the general ledger. And so it's kind of hard to see because it's a little bit small, but what they're trying to show you is that there's 4 steps to the posting process. So up top here, let me find my laser pointer here. Hold on one second. All right, so in this top part, this is our actual journal entry or the general journal. So this is the transaction. So in this case, the company received an investment by their owner. So they're going to debit cash to increase it for 30,000, and they're going to credit common stock to increase it for 30,000. But this is showing both sides of the transaction. When you post that transaction, the cash gets posted to the cash general ledger, and the common stock gets posted to the common stock general ledger. So this is like the journal entry, and then it gets posted. Okay. This is like a super archaic way of showing it because it's all happens automatically with technology these days, but it's important to understand what that process looks like and how to do it. Okay. All right, guys, buckle in because here we go. We're going to go through a bunch of examples and go through the 4-step process so that hopefully by the end of this PowerPoint presentation, you'll have a really good grasp on how to analyze transactions and you'll start to get the hang of this debit credit thing. Okay? All right, so we'd said just a couple slides ago, I believe, that there are 4 steps for analyzing transactions. Step 1, identify the transaction and any source documents. Step 2, analyze the transaction using the accounting equation, assets equals liability plus equity, right? Step 3, record the transaction in the journal entry form using the double entry accounting approach. And then step 4, post the entry. And they're going to show us posting it to T accounts to represent the ledger accounts so you can see it all on one slide. Okay, so in transaction 1 here, we're receiving an investment by an owner. So Fast Forward receives $30,000 cash from Chaz Taylor in exchange for common stock. So what 2 accounts are affected? Yeah, cash and common stock, right? And so cash is what type of an account? It's an asset account. And is it increasing or decreasing? It's increasing by $30,000, right? And then what about common stock? What type of an account is that? Where does it fall in our accounting equation? Under equity. And is our common stock account increasing or decreasing? It's increasing by $30,000, right? All right, so then the question you have to ask yourself is that in order to get my asset account cash to increase, do I debit or do I credit? And we said a while back that in order to increase asset accounts, we have to debit, right? So we put our debit of $30,000 here to our cash account. And then we said that in order to increase our equity accounts, specifically our common stock account, we credit. So you put your credit here. And then you post your debits to the left side of the applicable account, and you post your credits to the right side of the applicable account. So in transaction 2, Fast Forward is paying $2,500 cash for supplies. So we know 2 accounts must be affected. What 2 accounts are those? Cash and supplies, right? So cash is what type of an account? It's an asset account, right? And supplies are what type of an account? They're also an asset account. Cash is going up or down? We're paying cash for supplies, so cash is going to go down and supplies are going to go up, right? And so we said that in order to increase an asset account, we debit, right? So you have your supplies and your debit for $2,500. And then we said in order to make an asset account go down or decrease, we credit, right? So we're going to credit cash for $2,500. And then we're going to post our debits to the left side and our credits to the right side. Okay, in transaction 3, Fast Forward is paying $26,000 cash for equipment. So we know at a minimum 2 accounts have to be affected. And those 2 accounts in this scenario are cash and equipment, right? And cash is what type of an account? It's an asset, so it belongs on the left side of your accounting equation. And equipment is also an asset, so it belongs on the left side as well. Cash is going down, we're paying that money out the door for the equipment, and in exchange we're getting the equipment, and so our equipment account is going to increase. And so we said in order to increase asset accounts, what do? Debit or credit? We debit. And in order to decrease asset accounts, we credit, right? So our asset account equipment is increasing with our debit of 26 and our cash asset account is decreasing with our credit of 26. And then we post our journal entry to the general ledger, debits to the left side, credits to the right side, and we're done. In transaction 4, Fast Forward is purchasing supplies on credit from a supplier. So when Fast Forward purchases supplies, We know one of our accounts is supplies. What's our other account? When they say on credit, that means we're going to owe them in the future. And when we owe them in the future, we have a payable. And so the two accounts that are affected are supplies and accounts payable. So supplies is what type of an account? It's an asset account, right? And then we want that supplies account to increase because we bought supplies. So we're increasing our supplies inventory. And then accounts payable is also going to increase. That's money we're going to owe in the future. And so in order to increase our asset account supplies, do we debit or do we credit? We said that to increase asset accounts, we debit, right? And then accounts payable is a liability. And we said to increase liabilities, what do? Debit or credit? We credit, right? So then we post our journal entry to the general ledger, or in this case, the T account. Debits get posted to the left side, credits get posted to the right side. All right, so in transaction 5, Fast Forward is providing consulting services, and they're immediately collecting $4,200 cash. So what two accounts are affected? Cash, right? And consulting services. In this case, consulting services is a revenue account. It's services they're providing, right? So cash is an asset account, and it's going to increase by $4,200. And then consulting revenue is part of our expanded accounting equation, but it belongs in the equity section. And so revenue and equity have the same relationship. So as revenue increases, equity also increases. And here we're recognizing our consulting revenue increase of $4,200. So cash is an asset account. And in order to increase the balance in asset accounts, do we debit or do we credit? We debit, right? And then consulting revenue is a revenue account. And in order to increase the balance in revenue accounts, do we debit or do we credit? We credit, right? And then we post our debits to the left side of the applicable accounts and our credits to the right side. All right, so in transaction 6, Fast Forward is paying $1,000 cash for December rent. So if we analyze our transaction, the two accounts that are affected are cash and rent. Cash is what type of an account? It's an asset, right? And then rent is an expense account, and it's part of the expanded accounting equation. So when we said equity can be blown up into the 4 pieces, equity is increased by common stock, decreased by dividends, increased by revenue, and decreased by expenses. So rent expense and equity have inverse relationships. So as rent expense increases, equity decreases. And so what we really want to do here when we're paying cash for December rent is our expense is increasing. And so in order to increase our expense accounts, we have to debit. And then our cash account is decreasing, and we said cash is an asset. And in order to decrease asset accounts, we credit, right? And then you post your transactions to your general ledger or your T account in this case. All right, in transaction 8, we're providing consulting and rental services on credit. So Fast Forward provides consulting services of $1,600, and they rent their facilities for $300. And the customer is billed $1,900 for these services. So every transaction has to affect at least 2 accounts. In this case, we're affecting 3 different accounts. So the first one, they bill the customer. So when they bill the customer, that means we're going to have an account receivable rather than cash today. They're providing consulting services, so that's one type of revenue account. And they're renting facilities, so that's another type of revenue account. So your accounts receivable is an asset, and it's going to increase by $1,900. You're recording 2 different types of revenues. consulting revenue and rental revenue. Revenue is part of our expanded accounting equation. Revenue has the same relationship with equity. In other words, as equity increases, or as revenue increases, rather, equity also increases, right? So in order to increase our asset accounts receivable, we have to debit. And then in order to increase our revenue accounts, both consulting and rental, we credit. So our journal entry is a debit to accounts receivable for $1,900 and a credit to the two different consulting and rental revenue accounts for $1,600 and $300. And then we post our debits to the left side of the applicable accounts and our credits to the right side. All right, so in transaction 9, we receive cash on account. So in transaction 8, remember we provided those services to that client on account and created an account receivable. In this transaction, the client's paying us. So Fast Forward's receiving $1,900 cash from the client that we billed in transaction 8. So our two accounts that are affected are cash and accounts receivable. So our cash is going to go up and our accounts receivable is going to go down. So both of those are asset accounts. And so in order to increase our asset account cash, do we debit or do we credit? We debit, that's right. In order to decrease our accounts receivable asset account, we credit $1,900. And then we post our transactions to the general ledger. So you post your credits on the right side and your debits on the left side. All right, so in transaction 10, we make a partial payment on that accounts payable from the supplies that we purchased in transaction 4. So Fast Forward pays Caltex Supply $900 cash towards the payable we had from transaction 4. So what two accounts are affected? Cash and accounts payable, right? Cash is an asset account, so it belongs on the left side of your accounting equation. And accounts payable, it has that keyword payable, which means it's always going to be a liability when you see payable. That belongs on the right side of your accounting equation. Our cash balance is going down by $900, and our accounts payable is also going down. So in order to decrease a liability account, do we debit or do we credit? We debit. In order to decrease a cash account, which is an asset, do we debit or do we credit? We credit. And then we post the transactions to the general ledger. All right, in transaction 11, we're making a payment of a cash dividend. So Fast Forward pays $200 cash for dividends. What two accounts are affected? We have cash and we have dividends, right? Cash is what type of an account? Where does it belong in our accounting equation? Belongs under assets, right? In the left side. And then dividends are what type of an account? Dividends are an equity account. And so dividends, like expenses, have an inverse relationship with equity. So as dividends increase, equity decreases. And so what's being shown here in the accounting equation is the impact on equity, but the dividends themselves are increasing. And in order to increase dividends, we debit. And in order to decrease cash, we credit. All right, in transaction 12, we receive cash for future services. So Fast Forward receives $3,000 cash in advance of providing consulting services to the customer. And so what two accounts are affected? Cash and this advanced consulting services, right? Which is what we call unearned consulting revenue or unearned revenue. Anytime you see the term unearned, it always means it's a liability. Okay, that's another one of those key words. So our cash account is going up, right? We received $3,000. And then our unearned consulting revenue is also going up. It's a liability, but our liability is increasing until we provide those services. So in order to increase our cash account, our cash asset account, do we debit or do we credit? We debit, right? And then unearned consulting revenue is a liability, and we said that to increase liability accounts, what do? We credit. And then we post our transactions to the general ledger. All right, in transaction 13, we pay cash for future insurance coverage. So Fast Forward pays $2,400 cash for a 24-month policy, and that policy begins on December 1st. And so because none of the policy periods has expired because they're paying in advance, when we initially pay that cash, we have what we call a prepaid asset. And anytime that you hear the word prepaid or see the word prepaid in an account name, it always gives it away that it's an asset, right? It's another one of those key words. So in this case, the two accounts that are affected are going to be cash and then prepaid insurance. So cash is going down because we're giving it to somebody else. It's going out the door. Prepaid insurance, though, is going up. And then as the policy period expires, that prepaid insurance asset will decrease and our insurance expense will increase. So prepaid insurance is an asset account, and in order to increase asset accounts, do we debit or do we credit? We debit, right? And then cash is also an asset, but we set up here in step 2 that we're going to decrease that cash balance. And so in order to decrease an asset account, we credit. All right, in transaction 14, we're purchasing supplies for cash. So we pay $120 cash for supplies. So cash is going to go down, right? And supplies are going to go up. Cash and supplies are our two accounts. They're both assets. So in order to increase the asset account supplies, we debit. And in order to decrease the asset account cash, we credit. All right, in transaction 15, Fast Forward pays $305 cash for December utilities expense. So what two accounts are affected? Cash and utility expense, right? Cash is what type of an account? It's an asset, belongs on the left side of your accounting equation. Utilities expense is an expense account, which in the expanded accounting equation falls under equity. And we said that dividends and expenses have an inverse relationship with equity. And so as our expense goes up, equity goes down. And so what we're showing here is the impact on equity. But the balance in our utilities account itself is increasing. And we said to increase expense accounts, we debit. And cash is an asset. And in order to decrease asset accounts, we credit. All right, transaction 16, we're paying some expenses in cash. So Fast Forward pays $700 cash and employees' salaries for work performed in the latter part of December. And so our two accounts that are affected here are cash and salary expense, right? Cash is an asset, so it belongs on the left side. Salary expense is part of the expanded accounting equation, and it impacts equity. But expenses have an inverse relationship with equity. And so as the expense itself is increasing, equity is decreasing. We want our salary expense balance to go up. We paid more salaries, right? So in order to increase an expense account, we have to debit. And in order to decrease an asset account, in this case cash, we credit. And then we post those to the applicable T account. Debits get posted to the left side, credits get posted to the right side. All right, and then that's all of our transactions for this particular example. And so really what this slide is showing us is all of the T accounts with all of our journal entries that are posted. and the outcome or the balance. So it's kind of hard to see here, but we had 16 total transactions. And in our cash account, if I can find my pointer here, in our cash account, the sum of all of our debits less the sum of all of our credits equals a debit or a normal balance in our cash account of $4,275. And then our accounts receivable, we had a debit of $1,900, but then we also had a credit of $1,900, so we have an ending balance of 0, so on and so forth. And so these ending balances here, if you add all of those up, we have assets of $142,395. I'm sorry, $42,395. Geez, oh Pete's. And then if we go to our liability and our equity section or side of our accounting equation, and we add up all of the balances, we have liabilities of $9,200. We have equity balances of $33,195. $33,195 plus $9,200 better equal $42,395, or you have a problem. Okay, so let's work through an example together and see how you do. So assume Tata began operations on January 1st and completed the following transactions during its first month of operations. So on January 1st, James Setti invested $4,000 cash in Tata Company in exchange for common stock. On January 5th, the company purchased $2,000 of equipment on credit. And then on January 14th, the company provided $540 of services for a client on credit. So for each transaction, we have to analyze the transaction using the accounting equation, record it in journal entry form, and post it to the T accounts, which we're using in this case to represent the general ledger. So let's take each one of the transactions one at a time. So January 1st, we're just going to call him Jay because I don't know how to say that. Jay invested $4,000 cash in the Tata Company in exchange for common stock. So when we analyze the transaction, we're trying to figure out what accounts are affected and what types of accounts they are so that we can put them in the accounting equation in the right spot, right? So we said that $4,000 cash, so we know our cash account is affected, and we know our common stock account is affected, right? So when we put it in the accounting equation, cash is an asset, so it'll go on the left side, and common stock is a equity account, so it'll go on the right side, right? So we have assets increasing by 4,000 and we have equity increasing by 4,000. And so to record our journal entry, we know that cash is an asset, and to increase asset accounts, what do we do? Do we debit or do we credit? We debit, right? And then to increase liability and equity accounts for that matter, and specifically the common stock account, what do? We credit, right? So we're going to have cash increasing by $4,000 debit and common stock increasing by $4,000 credit. And then down here at the bottom, they remind you that assets, in order to increase asset accounts, you debit. Therefore, the normal balance of an asset account is a debit. To increase liability accounts, you credit. Therefore, the normal balance in a liability account is a credit. And then to increase your equity accounts, depending upon what type of account it is, you either debit or you credit. So if it's dividend or expenses, you're going to debit to increase those. But if it's common stock or revenue, you're going to credit to increase those. Okay? And then we post our transaction to the general ledger, or in this case, the T accounts. Our debits get posted to the left side. So our cash of 4,000 is going to get posted here, 4,000. And our credit to common stock is going to get posted here on the right side, $4,000 common stock. All right, so in the next transaction, the company purchased $2,000 of equipment on credit. So what two accounts are affected? Equipment. And then when they say on credit, that means that you purchased the equipment, but we haven't yet paid for it. And so when we purchase something on credit, we have an account payable, right? So equipment's an asset and accounts payable is a liability. So you have your assets increasing by 2,000, and then you also have your accounts payable or your liabilities increasing by 2,000. So in order to increase the asset account equipment, we said to increase asset accounts, what do? We debit, right? And to increase liability accounts, what do? We credit, right? So we're going to record our transaction on January 5th. We're going to debit the equipment account for 2,000. We're going to credit the accounts payable account for 2,000. Then we post them to the general ledger. Debits get posted to the left side. Credits get posted to the right side. All right, so then on January 14th, the company provided $540 of services for a client on credit. So what two accounts are affected? They're providing services, so we'll have our revenue account change. And then they're providing those on credit. And so when we provide services to a customer, we have an account receivable, right? So our revenue account's going to increase and our accounts receivable asset account is going to increase, right? So our assets, particularly accounts receivable, is going to increase by $540. And then our revenue, which falls in the equity section, is going to increase by $540. So to increase an accounts receivable asset account, we debit, right? To increase assets, we debit. To increase revenues, we credit. So on January 14th, we're going to record the account receivable debit, service revenue, credit. Then we'll post those to the general ledger, posting our debits to the left-hand side of the T account and posting our credits to the right-hand side. Okay, so in all those examples that we went through where we were analyzing the various transactions of the business and we were recording the journal entries and then posting them to the ledger, the next step in that process after all of the activity has been recorded is to prepare what we call a trial balance. So preparing a trial balance it's actually fairly simple. All it is, it's a fancy word for a listing of all of the account titles and the amounts or the current balances in those accounts. And so like we had talked about a couple slides ago, where we had the outcome of all of the transactions that we had posted in the T account form, and you had your debits on the right, or your debits on the left, sorry, and your credits on the right. And then if your debits exceeded your credits, you had a debit balance. And then if your credit column exceeded your debit column, you had a credit balance. All the trial balance is pulling the account name from those T accounts and the balance. And just like the T accounts or the ledger, on the trial balance you have two columns as well. And so your first column or the column to the left is where you put all of your debits or your normal balances of a debit. And then on the right side is where you put all of your credits or your normal balances of a credit. Okay, and so here's an example of a trial balance. So you have the company name at the very top, followed by trial balance, and then the date for which it's being prepared. And then typically the way that it works is you've got all of your cash accounts first, then your liability accounts, then your expanded accounting equation accounts, starting with common stock, then dividends, then revenue, and then expenses. And your debits belong in the column on the left, your credits belong in the column on the right. And when you've listed them all and you sum them up, your debits must equal your credits or you've got a problem, okay? Okay, so let's say that you do that and then it doesn't balance, your trial balance doesn't balance. So you have to find where your errors might be. So a couple places to look or ideas to sort of troubleshoot that problem. Make sure that your trial balance columns are correctly added, right? Did you just make a formula error when you were summing up all of the balances? make sure that you've entered them all correctly from the ledger. So did you transfer maybe the cash balance from your T account that was $6,300? Did you transfer that as $3,600 instead? So make sure you transferred all those balances correctly. Maybe see if you debited somewhere where you should have credited. Okay. And then other things to look for would be to make sure that the journal entry is correct, right? So did you do your journal entry backwards and debit where you should have credited or credit where you should have debited? Verify that your journal entry has equal debits and credits. So did you make a journal entry where your debits didn't equal your credits? So look for things like that. The great thing about accounting is you always know whether you're right. The bad thing is that if you messed up along the way, sometimes it can be a real process to try to figure out where you went wrong. Okay. All right, so then from the trial balance, then we take it the next step further and we prepare financial statements. Okay, so after we've prepared our trial balance, then we take it the next step further and we break up our trial balance and we put those accounts in the various statements for which they belong. So the trial balance includes every single account, but then only pieces, parts, or groups of those accounts belong on certain statements. And so we had talked about I think last week in the meet session, and I think in the pre-recorded lecture that I had done, we talked about the various financial statements. So on this slide here, we've got the four main financial statements. The balance sheet's here twice to illustrate a point, and I'll explain that. But so your four primary financial statements are the income statement, the statements of retained earnings, the statement of cash flow, and the balance sheet. So the income statement, the statement of retained earnings, and the statement of cash flows are all for a period of time. So we talked in chapter 1 about one of the assumptions behind accounting is that you can divide up the business into periods of time and you can report on those periods of time. And so typically you'll have an income statement, a statement of retained earnings, or a statement of cash flows for a month, a quarter, a year. Those are the typical time frames. And then the balance sheet is as of a point in time. Okay. So here's a better description of the four statements. So the basic gist here is that the income statement reports the company's revenue and expenses for a period of time. So revenue less expense equals net income or net loss, depending upon which category is higher, right? The statement of retained earnings explains the changes in retained earnings from net income or loss over a period of time, net of any dividends that have been paid as well. So basically, retained earnings is the accumulation of all of the company's revenues, expenses, and dividends paid for the entirety of its existence. Um, the balance sheet describes a company's financial position at a point in time. So it'll just tell you what the balance is and all of their asset accounts, liability accounts, and equity accounts as of whatever the date is that the balance sheet is being reported. And then the statement of cash flows tells you how a company makes its cash and spends its cash over a period of time. Okay, so here's an example of the income statement that results from all of those transactions that we had gone through. And so you'll see at the top, it says fast forward. It'll tell you what statement it is, income statement, and it'll tell you the time period. So when you're looking at an income statement, you're not going to see income statement as of December 31st. You're going to see for the month ended, for the year ended, for the quarter ended, and then the date that it ends because it's for a period of time. Okay, so you have your revenues less your expenses for net income of $3,395. And then you have your statement of retained earnings here at the bottom of this slide. So we're starting at zero because the business just started. We're taking our net income of $3,395 and it's getting pulled from the income statement down here to trying to find my pointer again. So you have your $3,395 from your income statement. That comes down here to your statement of retained earnings as an addition to the beginning retained earnings balance. Then we're going to subtract any dividends that we may have paid. to arrive at ending retained earnings. Okay, and then we have the statement of retained earnings here at the top. Our ending retained earnings from the statement of retained earnings comes down here to our balance sheet. And so our balance sheet as of December 31st, 2016 reports all of the balances from our T accounts or our trial balance in each of our asset, liability, and equity accounts. And then the retained earnings balance gets pulled from the statement of retained earnings, gets added to common stock for a total equity number of $33,195. So we have total liabilities and equity of $42,395 and total assets of $42,395. We're in balance, right? Okay, so I'm not suggesting that every accountant is like me, but most of us are very particular about our formatting. I personally can't stand ugly spreadsheets or ugly Word documents. It drives me absolutely insane. But nevertheless, there are some common standards for formatting in accounting. And so some of these things include like dollar signs aren't generally used in ledgers and journals. Uh, they appear on the financial statements and other reports, but it's usually just before the first and last numbers in the columns. Commas are sometimes used, sometimes not. I can't read numbers without commas, so I'm not sure why you wouldn't use them, but depends, I suppose, on the company and the preference and really the software programs that they're using, I suppose. And then typically amounts are reported to the nearest dollar, or even you'll see a lot of financial statements that are reported to the nearest thousands or millions, perhaps. So you can read about those more in the book, but I would say just be prepared to answer a multiple choice question or two about that. But the one thing that I will say when you're doing the homework assignments and they're asking you to prepare income statements or balance sheets and whatnot, uh, you won't miss a lot of points if you forget or you don't do it, but the headings are important. And so when they give you the format, so to speak, to fill in for the statement itself, make sure that you're picking um, the right period at the top. So if they want you to prepare the income statement, make sure that the heading on your statement is there and it's correct. And so if you have an income statement, you're going to want to pick, probably it'll be a drop down probably. You'll want to pick for the period ending or the month ending or the quarter ending, whatever the date is, not as of, and those will be the two options that they give you. So just make sure that you're paying attention to the headings of the statements and that you're completing those parts. Same thing with the income statement. You have a revenue section and an expense section. Make sure that you're labeling the sections and not just dropping in the accounts. I don't think you miss many points if you forget those pieces, but they're easy points to get if you can remember. So keep that in mind. Okay, so let's prepare the trial balance for Apple using the following data. So before we do that, let's remember what goes where on the trial balance. So you have a debit and credit column. Your assets have a normal balance of a debit, so they belong in the left side. Liabilities have a normal balance of a credit, so they belong in the right side. Common stock, normal balance of a credit, so those balances belong on the right side. Same thing for retained earnings. Dividends have a normal balance of a debit, they belong on the left side. Revenues, normal balance of a credit, they belong on the right. And expenses have a normal balance of a debit, they belong on the left. Okay. Then after you list all of your balances on the right side of the trial balance, your debits should equal your credits when you sum all of the balances. Okay. So I don't know if maybe if grouping them or seeing them like this will help you to remember, but if you can remember that assets, dividends, and expenses work the same direction, meaning you need a debit to increase those, and then you remember that common stock, retained earnings, and revenues and liabilities require a credit to increase those balances. Maybe if you group them in buckets like that, it will help you to remember. Okay, so let's prepare our trial balance. So one of the first things that I would do is I would go through the list of accounts and say, okay, I know that my asset accounts are the first accounts that have to show up on my trial balance. And so I think I would go through all the accounts and say, okay, what asset accounts do I have? So in the first column, the only asset account I have is cash, right? And then in the second column, I have a couple. I've got investments and other assets. I have land, and I have accounts receivable. So those are the accounts that you want to pull down first on your trial balance. So we'll pull our cash down, and then cash has a normal balance of a debit or a credit. Debit, right? It's an asset. So it belongs in the column on the left. Then we have accounts receivable for $17,460, land for $20, and then investment and other assets for $179, right? So then next, I would say, all right, liabilities are supposed to go next. So what liabilities do I have? I have accounts payable, other liabilities, and I think that's it. So then I pull down my liability accounts. So accounts payable belongs in the column on the right because accounts payable is a liability and liabilities are increased with credits. Then I pull down my other liabilities for $90,096. And then next I go to my common stock or I go to my equity section of my balance sheet. And I say, all right, what equity accounts do I have? Well, I have common stock and I have dividends, right? And I have retained earnings. And then I have revenues and expenses left, right? So you pull down your revenues. Revenues have a normal balance of a credit. Expenses, cost of sales, normal balance of a debit. Selling and other expense, normal balance of a debit. Then if I sum all of my debits and all of my credits, I should get to the same answer. Okay, so really, once you have the accounts and the balances, the only part that's, I guess, tricky or that you have to figure out is just whether the balance belongs in the right side or the left side of the trial balance, because otherwise you're really just transferring the data down to the statement itself or the trial balance itself. There's no math involved other than summing your debits and credits. So the trick here is just knowing what column it belongs in. Okay? All right, so I'm not going to get into a whole lot of this on the global view, but you can read about it in the book. They're just illustrating the difference in financial statement preparation between US GAAP and IFRS. Still the same four primary financial statements. The presentation sometimes is a little bit different, but you can read through that in the book. Okay, same thing here. You can read about the accounting controls and assurance and some of the SOX legislation in the book as well. Okay, so the last thing that I want to make sure we run through real quickly is this debt ratio. So let's do that. Okay, so the debt ratio. So the purpose of the debt ratio is to evaluate the level of debt risk of an organization, and it's computed as total liabilities divided by total assets. The idea here is that the higher the ratio, the greater the probability the company may not be able to pay their debt in the future. We had talked about how an organization finances its operations one of two ways, either through debt or through equity. The balance of, well, what's the right answer? How much of their organization should be financed through equity versus how much of their organization should be financed through debt? I don't know that there's really a right answer, but metrics like this will help clue readers of financial statements into, hey, are they gonna have a problem in the future if they have too much debt on their books? Okay. So here's just an exhibit. What they're comparing here is Skechers' debt ratio at each year in from 2014 to 2010. And so if you look at the trend here, the red line debt ratio, it looks like they had a debt ratio of 0.32 in 14, and they had a debt ratio of 0.28 in 10. So it looks like it's been slightly increasing over the years. Uh, So it depends. I don't know. Is that a good or a bad trend? I don't know. I don't know. Upward trends of a debt ratio can be kind of scary, but uh, the other thing that you can compare to, I guess, would be the industry debt ratio. And so while they have a trend of their debt ratio increasing, and the higher it gets, the more risk there is in the company's ability to be able to pay that debt. So although the trend is heading in the what I would call the negative direction, when you look at their debt ratio compared to the industry debt ratio, they're well below it. And so that's a positive thing, right? So that's how you look at I guess those metrics. Okay? Okay, guys, that's the end of chapter two. So, 1 hour and 14 minutes later, and I think you should be armed and ready to tackle some of the homework. If you have any questions as you get into that, please don't hesitate to reach out. Or if there's anything that was in this presentation that was unclear, I'm happy to go through that again. So, uh, take a try at the homework and then let me know what trouble you have, and we can go through those pieces. Take care.